And welcome to this morning's Financial Mastery and Retirement webinar presented by Lacers. Our mission here at Lacers Well is to enhance the quality of your life in your retirement, providing you with resources and activities that promote optimal health and wellness. Your Lacers Well program is based on 5 pillars of well-being, which is purpose, social engagement, finances, health, and community. So this is part two. We are recording both parts. So if you missed part one, that both recordings will be made available to you. So we are happy you could join us this morning. And so Rob, rather than doing a formal introduction like before, I'll let you say a few words about yourself before you get started, since this is part two. And so I'll now hand it over to Rob, our speaker for this morning.
Good morning, everybody. Welcome. Glad to be with you on part two here. Part one we did last week. I had a brief introduction there. My favorite topic is me, so I'm glad to talk about myself for the next few minutes, but I'll make it brief. I've been in the financial services industry for 37 years now. Most of my career has been spent working with public employees, municipal employees, nonprofit, public school, federal employees, and helping them to understand their benefits, how to organize them, and use them to the best of their ability to create a very comfortable retirement. Today, we're in follow-up to the first section, and I'll move to those slides in a couple minutes. I'll do a quick summary of what we went through, because we may have some new people on that haven't seen the part one. And for those that were on, maybe it'll be a little bit of a refresher. And then we'll move into part two with the different topics. So I'm going to advance the slide. Company that we represent, an education company, is Foursquare Financial Literacy Partners, and we've been authorized by Lacers to provide this content to you. And this is in no way saying that we're being, would say, endorsed or take it further, but this is the language that we have to put in here to the lawyers help us out with. But we're not being endorsed or above anybody or better than anybody. We've just been authorized to give this presentation. In the very end of this, as it relates to any Lacers benefits, whether it be your pension or your medical, et cetera, Lacers will be the ultimate arbiter on what is the correct interpretation of anything. So as questions come up, and there will be parts in which I'll reference many Lacers benefit pieces that, Lacers group, if you interject and want to jump into, please do any corrections that we would need to do or any clarifications, because questions will come up for things that I'm not entirely familiar with. I've been fortunate enough to work with the other pension plan there with LA City, the LAFPP, which is the police and fire, for the last decade in a very similar program. So we've become very familiar with the LA benefits. A little bit different with Lacers than with the police and fire, but very close. So welcome. Let's have a little fun today. If we get everybody to help or want to get you used to your chat box, type in, what do you want to hear about today? What made you get on today? What's important to you in follow-up from our first session if you were on it? Just have a little fun, and I will, as I advance the slides, I'll address them as we go through, but have a little fun and get used to the chat box as a little exercise. What do you want to hear about today? What's important to you? And what maybe in follow-up from our first session would you want me to touch on with as I go through the slides too? So have a little fun with that. Again, everything I'm going to do is very generic in nature, because with all the different people on and the different backgrounds and the different needs and questions, it's very difficult to do this very individually. But what I will do, I promise you, is to arm you with what you need to do to go back to somebody to maybe work with Lacers to clarify, or if you have a financial advisor to help guide you, or do I need an attorney, or should I get an accountant to help me out with these things? I'd be glad, and I will, through the course of the workshop, be able to address that and arm you properly. We're muted now. The group is not nearly as large as what we sometimes have. So we have the ability to mute and unmute yourselves. So I think we can ask the questions. I think we've opened that up to that. But we do have the chat box. Have a little fun with that. This presentation will be made available too by Lacers. And I've got summaries at the end of each section that kind of summarize up what do we want to accomplish by that little section that we went through. And then, of course, evaluation forms. Let us know how we do. We want to get better each time we do this and give you the information that is important to you. So the more we hear from you, the better these things get. So last week, we went through my introduction and the housekeeping stuff, and we went through, it's grayed out there, it says money is not math, eroding factors. What we talked about there was that in our planning, so many times we try to stress our income out in order to make more money. I mean, stress our investments out in order to make more money. When in fact, what we need to do is take a look at the things that we're doing and find out if we're losing or leaking wealth somewhere. And we call those eroding factors. And so we identified a number of eroding factors that could hit us through the course of planning for retirement if you haven't gone in or when you're in retirement. And we hit a number of those throughout the topics that are check marked there. But we started with understanding a work paycheck to a retirement paycheck and how they do differ, and how when you're working, a lot of things come out of your paycheck that don't come out once you're retired. And what we need to do is understand how to compare our top line versus our bottom line. We had a great session with somebody yesterday, helping them out, that said, there's no way I can retire. I didn't realize that, and this is an Los Angeles police officer. I need to retire. I can't retire. I take such a pay cut. And we did a comparison for him to show a work to a retirement paycheck. And this person actually got a $400 a month raise by not understanding that we're comparing our top lines. You should be comparing your bottom lines, because all that stuff comes out of your check when you're working that doesn't come out when you're retired. So that kind of sets the foundation for, now you have your LACERS pension and how the pension works and what comes out of your pension check. And that's a portion of your, we're going to call this your retirement paycheck. LACERS is one piece. Your Social Security, if you qualified for that, then we went through that too, and how we integrate that in, and some of the things that we have to worry about with using Social Security and claiming Social Security, like if my record, did I qualify? I heard my Social Security might get eliminated, and we kind of clarified that. It's not going to get eliminated, but you would be subject to what's called the Windfall Act. And in the worst case, you would never lose more than half of that Social Security benefit that you earned, just kind of giving a quick summary on that. Then we talked about the third leg of that retirement stool income, which is your deferred compensation, and where you had saved money at Voya, or maybe you've transferred out of Voya and you're working with a financial advisor, and how to create a retirement paycheck from that money, because that money you have a lot more responsibility for. You're responsible for the management of it, you're responsible for the harvesting of the income of it, and there's things that you have to be careful of. And I think the biggest worry that we had that came across the phone was at that time, or this workshop, was, am I going to be okay? Is the market going to turn around? Where should my money be? And again, those questions are so difficult to answer in such a big group. But what we did distill it down to is, what do you need the money for? And if you could sit back and figure out, what do I need the money for? That's probably the first step. That would then lead to, well, if that's what I need the money for, then how much should I be taking out? And then how much, and then that leads you into how you should be invested. And you can do this on your own, or you're welcome to work with financial advisors. There's very good ones out there that can help you in all of that. And then we talked about one of the things that is a huge eroding factor in retirement and going into retirement prior is just debt. Debt is a drag on your use, control, and enjoyment of retirement money. So let's figure out ways that we can reduce that debt, because $200 in a reduction, that goes into your lifestyle. That's not being thrown away or given back to a financial institution. And then we talked about if you had other employment, things that we have to be careful of with in collecting Social Security. So that was part one. Now we're going to lead into part two, and another eroding factor we're going to have is going to be federal and state taxes. And I'm going to go through how we're taxed and kind of explain to you the stair step that we're taxed on. And then we're going to talk about state income taxes, because there are ways, if you do move out of state, and many of you may be moving out of state or wanting to move out of state, and by becoming a resident in another state, you can maybe eliminate the state taxes that you're paying, and that is a raise in retirement. Then we're going to go through, just very briefly, part of the Social Security Act includes Medicare. And one of our biggest expenses and eroding factors in retirement is not only health care costs, but also for the premiums, but also the care itself for what we're responsible for. And really, the next check mark, which is long-term care, is the biggest eroding factor that we see of retirement incomes in retirement. If you've been looking at your deferred comp statement and you think it's going down, and that's scary, it's spending that money when you need it in order to pay for your care. We just see these retirement accounts getting eroded very, very quickly. So I'm going to introduce to you a little bit about what is long-term care insurance and why might you want to consider it in protecting your retirement lifestyle, your portfolio, and others that you love in retirement. And then we're going to talk about estate planning. And that sounds like it's all for rich people, but it's not. It's for everybody on this call. Estate planning is about getting your stuff where you want it to go when you're no longer here. And it could be including very specific wishes beyond the grave that on how your estate or your holdings would be treated. And then we're going to put it all together with some quick, brief bullet points, and then we're going to close out for questions. So that's our ride for today. Strap in. For those that are old enough, let's try to make this an e-ticket ride. You'll know what I'm talking about. Did I get anything in the chat box? What is the annuity part of my paycheck? Where does that come from? Well, I got that question. I'm not sure, Jay, exactly what the question means. Annuity is retirement income, so that I think you're referring to your LACER's pension, which is also oftentimes referred to it as annuity or a monthly paycheck for you. Social Security kind of works like an annuity too. Annuity the word comes from long ago, loosely translated means income for life, and it was brought to us in Roman times. When you served the state for a certain number of years, they would grant you a retirement or an annuity or income for life, annual income for life. So feel free to add more in there if I didn't answer your question. So we're receiving our retirement income. It's coming from LACERS, it's coming from Social Security, and it's coming from our deferred compensation. So that makes up our retirement paycheck. And you may have your own employment. You may have gone back to work, or you have self-employment, or you created your own business and you have income there. But it's going to be all these sources of income. So this is the first of our life's guarantees, taxes. We can't, can we eliminate them? Can we minimize them? So first of all, I like to point out, these are common questions or common things that come up in this section. Retiree tax bracket. I hear often, I'm in a retiree tax bracket, and there really is no such thing as a retiree tax bracket. It's kind of like the unicorn. We've heard about it, but we've never seen one. There is no retiree tax bracket. There is just tax brackets, whether we're working or whether we're retired. Tax brackets we do have, though, we refer to a couple different ways. One is called a marginal rate, and one is an effective rate, and I'm going to show you how those work differently. Will I pay lower taxes because I'm retired? You'll pay lower taxes if you make less money. That's for sure, but not because you're retired. Is my LACERS pension taxed at retirement in my state? And I'm going to show you what states may not tax your LACERS retirement. The other thing that we talked about in the previous section in debt reduction is you have a lot of losses of deductions as you get closer and closer into retirement. Your kids are grown, you can't deduct them. I have 3 kids, if you may remember. They're 29, 26, and 16, and they're actually all in my home right now. The 29-year-old is back in because her husband's deployed. My 26-year-old moved back in, and my 16-year-old is still in high school. I can't rededuct my 29 and my 26-year-old, unfortunately, but you do have a lot of loss of deductions. Your mortgage, as you pay it down and you get more and more towards principal, you lose the interest deduction, so that goes away. All your income is potentially taxable, and then we do have a history of taxation in our environment that is kind of knocking on the door that we may see increases. So we don't really know what holds there. Then we've got estate taxes if you have too much stuff and you pass it on to the next generation. And then we have other taxes like, will our Social Security be taxed, which we talked about last time. It more than likely, for all of you, 85% of your Social Security income will be taxed. You got property tax, you got sales tax, and anytime we can eliminate or minimize some of those things, then it adds back into your pocket for either your investing opportunity or to just go out and spend it and enjoy your life. So we want to make sure we're not leaking some of these areas of taxation. So this is a chart that just shows briefly what I want to explain with this chart. We are taxed on a stair-step system in this country. And every stair-step, if you think about it, it's got a rise, which is, kind of the step up, and they got the run, which is the tread that you put your foot on. And then you finish that step and you go up to the next rise and the next run and the next rise and the next run. And this chart represents the very top stair step of the taxation staircase. And what it shows is that from 1913, at the very front end here, our taxes, we weren't federally taxed until 1913. And the rate for those 3 years, first 3 years, was 6%. That was the top stair step of the tax system. And then we had World War I come out, and we saw these tax rates shoot up. Now, that doesn't mean that's what people paid. That's what they paid if they were on that top stair step, which I'll explain to you how that works. And you can see there were points in time when there were people that paid 90% of the income on that stair. Again, I'll explain to you what I mean by that stair when you see the next slide. And can you imagine that you would only get 10% of the income that you would receive from your work? Amazing, 90%. And then we see a lot of adjustments down over the years. We have Tax Reform 86, then we've seen it kind of come up and around, and we're right now at a 37% top rate, and then we add in the Affordable Care Act surcharges for certain incomes. It's operating up close to 44% just at the federal level. This is what I mean by the stair step. How are we taxed at the federal level? Again, this is federal, not state. We got to separate those out. So what we have are the different tax brackets: single filers, married, joint, head of households, and there's another one for estates and trusts, but there's not one for retired. These are the very basic tax filing statuses. And then what we have is the stair here. From 0 to 10,275, that's the rise. The run, I'm taxed at 10%. And then at my next 10,275 to 41,000 of income, this would be taxable income. I'm taxed at 12%, and then on up. And then you climb up that stair step. So you see, as your income goes up, with each stair, you get taxed progressively more and more and more. So I'm going to run you just through a quick example. And I'm going to use, again, simple numbers, rounded up numbers. They may or may not be realistic to you, but they make it easy for me because I went to a state school. But I'm married, and I make $120,000 a year. And I'm able to take all my basic exemptions, my interest deductions, whatever they may be, deduct the kids, and now my taxable income is down to $100,000. How am I taxed? Just to go through this real quick, and I'm going to round up to make it easy. But on this first stair step, the first 20,000 of my income, and I got 100,000 of it, that's taxable. The first 20,000 of it is taxed at 10%. So that's $2,000 I'd pay on that stair step. My next 60,000, I'm taxed at 12%, which is $7,200. Now I made 100,000, so I go from 80, again, I'm rounding up, 80 to 100. I got $20,000 that's taxed at 22%. So I'm going to pay $4,400 on this stair step. I'm going to pay $7,200 on this stair step, and I'm going to pay $2,000 on this stair step. So if I add that all up, it's about $14,000 as I progress up the income range. So my marginal rate, as we go back to the previous slide, we were talking about 2 slides. Oops, went too far. My marginal versus effective rate, how are those different? My marginal rate is going to be the stair step that I'm on. So I'm on a 22% stair step, so that's my marginal rate. My effective rate is the blend of all three of these stairs. So I paid $4,400 on this stair step, I paid $7,200 on this stair step, and I paid $2,000 on this. The blend of that is $14,000 on $100,000 of income, taxable income. My effective rate is 14%. So when you do your taxes or you have somebody prepare them for you, oftentimes the cover sheet for these TurboTaxes, et cetera, will say your marginal rate is 22, your effective rate is 14. And that's the difference between the two. Your effective rate will be the blend of all of these stairs. Now, what happens if I decide to take another $50,000 out of my deferred comp or from another taxable source, or I make another $50,000, how am I taxed? Whether I pull it out of my deferred comp or whether I earn it, if it's taxable income, it just gets added on to my stair. So I was at $100,000 of taxable income here. I added $50,000 to my income because I took it out of my deferred comp. Well, now I made $150,000. So $150,000 still has me on this stair. So I know that while I'm on this marginal rate or this stair of 22%, I would pay $11,000 in federal taxes on that stair. Oftentimes people will say to me, well, I want to yank all my money out of my deferred comp, and I just want to pay the tax and I want to pay off my home. And I get that. I understand that. I empathize with that. It's nice to be able to have that security of not having to pay a mortgage. So I got $500,000, for example, in my deferred comp. again, easy math, maybe unrealistic sum, maybe real. All I do is I made 100,000 of income. I took out 500,000. Now I'm at 600,000. So I'm going to be on this stair step right here, this 35% stair step. So I'm going to pay all the tax on this stair step, and then this stair step, and this stair step, and this stair step. So you can see how you progressively would pay more and more as your income goes up. So that's how we're taxed on the federal system. Got a direct message here. Where will my retirement money be safer, annuity or stock investments? Well, that's a tough one because it's very individualized. If you want it safer, then you need to have it in instruments that would make it safer. CD at a bank, you could open an IRA and put it in a CD at a bank, but you're not going to yield anything. You're not going to earn anything. An annuity is issued by an insurance company. An annuity can do two things for you. It can grow your money and protect it. It can also distribute your money over time periods. So it can do both. And if the investments behind the annuity that you're experiencing are fixed investments or interest rate driven or index driven where you can't go backwards, then that tends to be much, much safer than being in market conditions. So I hope that helps you there, Data. Why is it only 14,000 at the 12% tax rate? 14,000. I'm not really sure what the question is there, Pat. The 12% tax rate, if you look at this, the spread is about 63,000. The total tax. Go ahead.
Okay, so you.
Pat, I think you are muted.
It didn't come through.
On the
Pat.
example you gave,
Yeah.
on the 100,000, you said the first 20,000 you'd be taxed at 10%.
Right.
And then I may have misunderstood, but what I understood was you said then 14,000 would be taxed at 12% and the rest at 22%. Okay.
No, 14,000 would be the entire tax you would pay on all stair steps. So you'd pay 2,000 on this stair step, you'd pay $7,200 on this stair step, and you'd pay $4,400 on this stair step. And if you added them all up, they would equal about 14,000. I think the number is 13,600 to be exact. I just rounded it up.
Okay. Okay. Thank you.
You're welcome. Now, we're going to get off of federal taxes. Oh, by the way, another thing on federal taxes that comes up very often is I'm going to move out of this country and I'm going to go to Costa Rica. So what happens there? Well, you're still going to pay federal taxes when these monies come out. You are still going to have to pay those taxes. One thing you have to be careful of is if you move to that other country, will that country also tax your income too? So you have to be very careful. If you're looking to get out of the country, you need to work with a tax advisor and say, listen, I'm looking to go to so-and-so, this country. What do I have to worry about? I've got my federal taxes. They may be able to help you understand what you may be paying in another country too. There is always that possibility. Now, if you move out of the country, you don't have state income tax anymore. But if you live in the United States, not only do you have federal income tax, but then we're taxed at the state level. And this map that came up is not a representation of anything political. It is, I hijacked it from another site, which I'll share with you in a couple minutes. But what you see here are red states are states that don't tax you when you're working, and they don't tax you when you're retired. There's no state tax on monies that you earn or monies that you retire on. So red states, that is a good thing. So if we are in a gray state, which is California, all the gray states, they tax you while you're working and they tax you while you're retired. The yellow states, where we have Tennessee and New Hampshire up here, Tennessee and New Hampshire, let's load all these states' names up here. Tennessee and New Hampshire, they have a limited taxation, not necessarily on income. They may tax you like your interest on your checking account or et cetera. But they're not going to tax your income or your retirement income. So we got red states that don't tax you at all. We got yellow states that won't tax your income or your retirement income. And you have gray states that tax you while you're working and may tax you when you're retired. But there's many gray states where they don't tax certain retirement incomes. and that would be your LACERS income. So the game that we see a lot in California is, boy, did we see some bargains when we saw the market drop dramatically in 2008. And a lot of people went into Nevada and they bought an apartment or they bought a condo. And I mean, you could pick up something pretty remarkable for $250,000, $300,000. And we've held on to that. I see the game all the time, and people ask me the question, well, I'm just going to go to Nevada. I'm going to make my address as Nevada, and then I won't pay California state taxes anymore. And California knows that game. They know that if they have a goon squad that will audit you, and they will try to pull you back into California and say, you owe income in California. And they usually look at your lifestyle to determine that. They're going to wonder why your electric bill is so small in Nevada in the summertime. They're going to wonder why you still see the doctors here. Why do you buy gas in California but not in Nevada? And they're going to draw you back into California. So your best, again, to gain the advantages of what these states are offering you in terms of taxation, you have to become a resident of that state. So my advice there is, again, going back to an accounting professional and let them know, I'm in California, I have this property in Nevada, I need to become a Nevada resident, and have them help you ease out of California and gain the residency of that state in the end so that you can get the benefits from it. I have people that have gone this extreme. I had one guy I'll never forget that said, I got a P.O. box in South Dakota, and that's going to be my new address. And then, okay, it's all deductible till you're audited. So be very careful of playing the state-by-state game. Now, some of these gray states, though, won't tax you on your retirement income. And your retirement income is a couple different pieces. The retirement income, remember, is your LACERS pension. Your retirement income is your Social Security. And your retirement income is your deferred compensation. So it's really just not all your retirement income. It could be all three of those pieces, but it may only be one or two of those pieces that they don't tax you on. Like, for instance, California won't tax your Social Security income at a state level, but they're going to tax your LACERS and they're going to tax your deferred compensation money. We can go into Illinois. Illinois is not going to tax your LACERS or your deferred compensation or your Social Security. So it goes state by state. And where you can go, I'm going to change a slide here for a second. I'm going to move something over to the screen. Bear with me a second here. Let me. Bear with me a second, trying to move this over. And I'm going to give you the link for this. This is a fun site to go to. This is Retirement Living, Taxes State by State. And on the next slide that I'll show you, it'll have that link for you. And you can go and click on one of these states, and they'll highlight. You can see as they highlight. And they're not only going to show you how it would treat your LACERS pension, or it would treat your deferred comp withdrawal, or if you moved your money to an IRA. They're also going to show you the taxes for property, for cigarettes, for gasoline, for everything. It'll show you everything. So, for instance, if I go to North Carolina, go there real quick. Let's see if this should load up all right. I don't want to stall this thing out too long. So somehow it gave me Wyoming. I must have clicked on that, but I clicked on North Carolina. But here's, for example, is New York. Retirement income taxes, Social Security are tax exempt. Civil service and New York State or local government pensions are exempt. The state also exempts up to $20,000 of qualified pensions. For those 59 and older, that would be like your deferred compensation. So, Elijah, am I still sharing? Am I okay?
Yes, I see your taxes in New York to Wyoming page, and you're looking at the bottom part, New York sales tax.
Yeah. So, and I only put this up on the screen just so y'all can see that I'm going to show you the slide where the link is. You can go on and have a little fun with that. Interestingly enough, what I neglected to show you, that if you live in New York City and you smoke, that the state of New York taxes you $4.35 for a pack of cigarettes before you buy them. And then if you buy them in New York City, it's another $1.65. So it's $6 in taxes before you even pay for the smokes. And in North Carolina, it's 45 cents. So when I go through the taxation on this, all I really want to bring to your attention is that if there's any way to minimize or eliminate a tax, that is going to add money into your pocket. And it may seem trivial and minor, but if you're saving $300 a month in state income taxes, then by moving to another state or having part of your income tax exempt, that's your money. That's back in your pocket. And we extrapolate that over a year and over 20 years and over 30 years. It's a lot of money. Last little piece here is when we spend our money, we're taxed too, and that's our sales tax. And a lot of people that are on here, I'm in Orange County, California, but a lot of people on might be in LA County, and I believe LA County is 9.75%. I had a guy that retired back a few years ago from the federal system here in Long Beach. He was working at Boeing, and he goes, "Hey, Rob, I'm going to move right up here to Washington State." And I said, "Oh, yeah, you're going to eliminate that state income tax." And he says, "Yep, and I'm going to live right here on the border. I'll be 2 blocks from the border." And I said, "I don't understand what's so important about that." He goes, "Well, Oregon's got no sales tax." I thought, wow, I didn't really make a lot of it. But when you think about it, in Los Angeles, everything's got a sales tax on it, 9.75%. And through the course of a year, if you spend $40,000, that's $4,000 in sales tax. And it's what we pay. We're used to it. It's just part of what we do. But when you actually break it out and look at it, you say, that was $4,000. And you look at that over a period of a retirement years, that's a lot of cash flow that you've lost the use, control, and enjoyment over. So just being able to eliminate or minimize your federal or your state income taxes can help you in increasing your retirement spendable income. And with the loss of deductions that you have as you get closer or you're in retirement, some of the things we had talked about last time, like turning a hobby into a business or turning your toys into tools and creating tax deductions, is something that can really help you not only have your hobby, enjoy your retirement, but create tax deductible items too. So here's the link that I just went to. And again, you'll have this presentation available, but it's you can all see it here. If you have a camera there, or you can take a picture of it, but retirementliving.com, taxes by state. It's kind of a fun site to go through and look at.
Hey, Rob, if
Yes.
the list of links you had in part 1, was this included? Do you know?
This will be at the end of, it's here and it'll be at the end of all the presentations. We'll all have your LACERS links and a whole bunch of different links for them.
Okay, then we'll pull from that as well and make sure that we email those links out.
Now, I got a question that came in. We're saving into the deferred comp program and regular IRAs. Okay, those are both retirement plans. It was assumed all those years that we would be in a lower tax bracket when we would start drawing the distributions. We were surprised that the minimum required distributions put us into a higher marginal rate. Yes, Nancy, you are correct. That's bad news. The good news is that means that you're making more money. And I know that taxation and seeing that hurts. Maybe if there's ways to, if there's ways to increase tax deductions could help you out. But that's a really good question. You see that all the time. And I'm going to take you through something that hits you even worse when it comes to Medicare as you make more money or as your income goes up in retirement. And yes, your deferred compensation and your IRAs, we went over it in the last section a week ago. You got to start paying those monies out at some point in time. The government wants the income and the tax revenue from it, and that's called required minimum distributions. And that could help bump you up into next marginal tax brackets, and it can sometimes push you up and cause you to pay more for your Medicare protection Part B. We'll hit that in the next section. Great question. I got another one. Are RMDs from annuities and IRAs considered pension income? Yeah, they're considered retirement income. They're considered regular income, but they're not earned income. And the difference from that is earned income you pay Social Security taxes and Medicare taxes on. RMDs, IRA, you do not pay any of those Medicare or Social Security taxes on. Another one out here. On my paycheck, I receive an annuity and a pension. The majority of the paycheck is from the pension. I believe the city pays into the pension. Is the annuity from the part I paid into my retirement? Do I have the option to delay receiving that payment from the annuity? Are there any advantages or disadvantages? Jay, I'm not super familiar with that supplemental annuity you could purchase along with your pension. If you paid for it with pre-tax dollars, like where it came from your deferred compensation in order to purchase it, then you would pay tax on it, more than likely. I'm not sure if you have the ability to delay it once you've purchased it, though. So I'm going to have to send you back or maybe somebody on Lacers might be able to help us here now. Stephanie, I got your question. What? Yeah, don't smoke in New York City, right?
Yeah, unfortunately, I don't think we have anyone from the RSD team here, but you can call into Lacers and ask about the larger annuity and get assistance that way.
Thank you. All right, so what is my marginal rate? What's my effective rate? What percentage of my retirement income is going to be taxable? For a lot of us on the call, it's going to be most of it. Do I have any tax deductible expenses in retirement that maybe can help me out? And what's my retiree tax bracket going to be? No such thing. It's going to be wherever you land on that chart that we went through. They're just tax brackets. Now, I'm going to move through this section here. This is a very important piece. There's a lot of pieces that are very unique to your Lacers benefits, and I'm not going to go in too deep to this. Not super familiar with it, only because I'm not exposed to it a whole lot. But health insurance, the premiums and health insurance, what you may be responsible for and paying, are another big eroding factor in retirement. So your retiree health plans and understanding Medicare, we're going to go through some very basic high-level things just to be careful of. And questions, a lot of them will have to be actually reflected back to the Lacer staff. I think we do have the people on that do have the answers for some that may come up. So I'll do my best to either deflect or to answer them. But Lacers offers retiree health plans, and you want these health plans. They are wonderful. For somebody just like me, who's been paying my own health insurance my entire working career, being self-employed, I pay for my health insurance, and the only protection I'm going to have when I get into retirement is going to be my Medicare at age 65 and my A and B Medicare. That'll be my primary coverage. And then I have to find something supplemental, which I can either be a Medicare Advantage plan or I can use a supplement plan. So that's what will be kind of my cocktail mix for my health care. And it may not be that comprehensive of a mix, whereas you have your Lacers coverage, which is a very comprehensive plan that's really nice backstop to have in the mix of your Medicare plans. So some items here, and again, there's a lot of things down here on Lacers.org, the health benefits guide. We got the link down there at the bottom of the screen. But retirees and or covered dependents age 65 and over must enroll and maintain Medicare Part B. So for those that are doing it, I know you probably know that, and you must enroll in and maintain Part A. Now Part B is going to have, you're only to enroll in Medicare Part A only if you're entitled to it premium free at no cost. And what that means is that, how would it be premium free? It'd be premium free if you've paid into the Medicare system and you've qualified for Medicare. So you've paid your Medicare Part A premiums. They're paid while you're working. So very, very basic stuff here, and again, more extensive stuff either through the staff or on the health benefits guide here. High level, for those 65 and over, your Part A of your Medicare is your hospitalization, and that's the one that you pay for while you're working. Your Part B is going to be one that you'll pay for once you file at age 65 for that, and that's your doctor visits, your x-rays, your blood tests, and all that stuff. And Part D is prescription drugs. But note there in red, Part D is already integrated into your Lacers Medicare plan. So you do not buy that separately. Your prescription drugs will be covered by your Lacers Medicare plan, your Lacers program. So what this comes down to, when you retire, some items to be of caution. Next couple slides here. You kind of have a cocktail of health insurance when you're in retirement. You got your Medicare Part A, you got your Part B, and then you've got your Lacers. So it's recommended that you enroll in the Medicare 3 months before turning age 65. Effective date of your Medicare will be determined based on the month you applied for Medicare. At 65, you are required to enroll in Part A, hospital, only if you're entitled to it premium free, and Part B, the medical insurance. And again, the Part A, it's free because you've already paid for it. The medical Part A then has no premiums at that point. Part B does have a premium. That Part B is $170.10 in 2022. That can be deducted from your Social Security check, and then LACERS will reimburse you for the Medicare Part B premium subject to the plan terms. But LACERS will never pay your Medicare premiums. So that means it's not coming out of your LACERS check and going over to pay for your Medicare. You're responsible for paying that premium. If you don't get a Social Security check, say, well, Rob, I don't get one of those. Well, you will be billed quarterly from Part B premiums, and you're responsible to use any of the Medicare offered payment plans. I believe they also still have a monthly program and automatic draft plan too. So that Medicare Part B premium is important that you pay for and you keep in force while you're in retirement in order to keep your LACERS health plan activated. Now, Part B is means tested based on your income. What does that mean? We got to be careful with that. Part B premiums can go up. That $170.10 could be higher than that depending on your income in the previous year. Again, we got the link down here for the health benefits guide. Let's create our cocktail here just real quick. This is simply how it works. Medicare Part A, Medicare Part B, and then retiree coverage. It's going to cover 80%. What the retiree does, what it doesn't cover, then we file with our retiree coverage. And that's going to be kind of our cocktail mix. I should turn this upside down and put a stem on it so it looks like a martini glass. But that's the mix of our of what your medical insurance, where it would be paid from, where it would come from. So, quick caution items here. You do not enroll in more than one senior medical plan, otherwise you'll be terminated from your LACERS plan. Do not enroll in any individual medical plan or prescription plan, otherwise your plan will be terminated. If you fail to enroll in Medicare, you will lose your LACERS coverage. Late Medicare enrollment, caution item 2. If you miss your Medicare premiums or it lapses, LACERS is going to be notified and you lose your LACERS coverage. And so if you have questions around any of these issues, you got the site there, lacers.health@lacers.org, or you got the folks on the line here too. Let me see if any questions have come through. Open enrollment is, Stephanie put out there, open enrollment is coming up, so please watch out for LACERS communications coming in your email box, okay? Yeah, this becomes kind of a surprise. So my income in 2021 was X. How does it affect, remember I mentioned that your Medicare Part B premiums are means tested. Means means your income in this example. So Medicare means testing is based on your, what they call modified adjusted gross income. Oftentimes gets confused when you do your taxes with what your adjusted gross income is. Your adjusted gross income is where you start your taxation. Modified adjusted gross income is different. They include different things in modified adjusted gross income than they do adjusted gross income. And this is looking like the tax chart with the stair steps. But you can see that if you're an individual and your modified adjusted gross income is less than $91,000, you're going to pay the $170.10. If you're married and you're filing jointly, it's less than $182,000 that you'll continue to pay the $170.10. But if your income goes up in any year, then that could increase that premium for the next year. Excuse me. The one that I see that affects everybody, I hear it all the time, is I sold my home and I made $200,000. We were making $120,000 married. I sold the house. Our income went up by $200,000 in what they considered modified adjusted gross income. So now I made $320,000. Well, you're going to be on this stair step here. You're each going to pay $442 a month for your Medicare for that year until the next year when your modified adjusted income goes back down. So sale of stock, a distribution from your deferred compensation program, a sale of a home, things that would be taxable income can cause your Medicare Part B premium to go up. It's not a permanent increase, but if it continues that you make that money every year, it would be. But if it's a one-time event, it could affect you for a year. So what are things that are included in modified adjusted gross income? Well, things that can increase your, and they call it MAGI or MAGI, Social Security. When you take Social Security income, that's going to increase it. If you go back to work, any wages or salary that you earn, that's going to increase it. Your pension from your your lacers, that'll be included. RMDs, when the government forces you to take money out of your IRAs or your deferred compensation, that increases that income. Dividends that you receive from investments, capital gains, that's where you sold your home and made some money. IRA distributions, muni bonds. Just to show you how they include that is, municipal bonds, if you purchase them right in California, they create income for you, and they could be federal and state tax-free. So I could make $1 million a year from muni bonds, just to give an extreme example, that none of it's taxable. So my adjusted gross income is zero. However, my Magi, it is included in. So I would be at this 6th level, this would be my premiums for my Medicare for that particular year. It's not moving, there we go. So things that don't increase your modified adjusted gross income, if you have life insurance and you have money that you take out from your life insurance, doesn't include that. Non-qualified annuities, those are payouts or annuities that you purchased with after-tax money, not retirement pre-tax money. If you saved money in an HSA and you take that money out, that's not considered. Your Roth deferred comp or Roth IRAs, that's not considered income. Longevity insurance, I'm going to talk about that next, but that's primarily like benefits you would receive from long-term care insurance. And if you had a reverse mortgage, these are all things that would not increase your modified adjusted gross income. But for most of us here, this is where our income is going to come from. So you may experience at some point in time once, or could be longer than 1 year, an increase in our Medicare Part B premiums. So let's see, no more questions came through. I'm good there. So the last really enormous eroding factor we see in retirement is going to be long-term care. Long-term care is not insurance. Long-term care is your plan for your care should you have a change in health that requires it. So we're living longer, but what about the quality of life? My grandpa was a pathologist in the city of Los Angeles. He was the first pathologist at St. Vincent's Hospital at 3rd and Alvarado. And then eventually he moved over to USC, County SC, and then he retired from Hollywood Presbyterian. And my grandpa always told me, grandson, keep your mind clear because in your lifetime the replacement parts are on the way. And he's right about that. We're living longer, but does it mean we're living better? Not always. So if you're in retirement, you're bumping along, and you have a change in health that requires care, we have to kind of look through the list of items of where we'd receive that care from. So probably the first place we would all turn to is a spouse. But what if your spouse is unable because maybe they're ill or they're frail or, in my case, unwilling, my wife? What if they're unable or unwilling to do so? Well, then you've got your next in line. I'm going to look to my kids. But what if they're unable? They live out of state, or they're unwilling too. They're not going to be able to put in the time. I've got family members, but I'm not going to burden family members with that. So then I go down the hierarchy and I say, okay, well, I got to hire somebody. And when I hire somebody, you got to pay for them, and they usually will come out of your assets. Now, you may say that, I've got insurance. I'm going to address this in a couple of bullet points, but there's not a lot of coverage out of the insurances that we have that will cover your care, particularly for a long period of time. So one thing that you can look at too is an insurance contract. And there's insurance that you have through the city of Los Angeles. There's many vendors that offer the long-term care protection. But I can tell you, having cared for 2 sets of grandparents in our home, that proper long-term care planning can keep your family together. And I'll explain what I mean in a couple slides. But you say, I got health insurance. I'll have Medicare. Maybe I have disability coverage. Well, your health insurance is not going to cover an extended care event. Medicare will cover you for some extent, but it has to follow a hospital stay. And you're only going to be looking at 100 days maximum, and you're going to pay for some of the costs during that 100-day period of time. My dad was in a facility, and we were trying to get him out of the facility for a long period of time because he would get better care at home, but they wouldn't release him until day 99. Wow, it was a miracle. They let him out at day 99. Got another question that came through. When I turn 65, how will I know I'm supposed to do this? Through an email, a form through my mail? The question ended up, could you avoid that increase by buying another house that same year or sign up for senior living? You know, again, to avoid that increase, it's got to not be taxable income. So if you, I don't think there's such a thing as a 1035 exchange anymore from home to home, where you could take that gain and roll it into your next home and not pay the tax on it, or have it show up as taxable income. So I think this came from Russell. I think you do want to check with a tax professional how that's going to work. How will this affect and show up as my modified adjusted gross income, not adjusted gross income? So you definitely want to check with a tax advisor on that one.
Hi, Rob. The question I asked was not about the house. My question was in relation to, you know, oh my God, if you don't sign up for this at 65, you're going to lose your LACERS, or if you don't do this, you'll lose that. How do I know by the time I turn 65, like, when am I supposed to do this? Does someone notify me and say, hey, Russell, you need to sign up for Medicare or whatever, or you're going to lose everything?
Let me refer that over to LACER staff and see, do you folks send out anything as a reminder to them at 65 because of the tie-in?
Yes, it's my understanding you will get a communication from LACERS, but you also should, attend the open enrollment meetings because they do go over that turning age 65. We do have some retirement. I'm sorry, not retirement, but we do have some seminars, some Medicare seminars coming up. So it's best to educate yourself as well, and not completely depend on LACERS to let you know as well.
Great. And do you recommend doing that when you're turning 65 to join that meeting closer to when you're 65?
I would do it months before because you can,
Right.
Exactly, as you know, you can enroll in Medicare. I believe it's 2 to 3 months before, and I believe LACERS it's 2 months that you should be enrolling in your Medicare.
Great clarification. Yeah, very important.
You're
Very important.
You're on mute, Russell. Did you have something else?
No, thanks. I'll just check that out when it's time.
Yes, go to the LACERS website. I really strongly encourage you to register for the upcoming Medicare seminar. They do have one coming up soon.
Okay, thanks.
I got a great question that came in, Alan. I see that RMD increases modified adjusted income, but Roth doesn't. Isn't the RMD part of the 401k or IRA? Yes, RMD is part of the 401k and RMD as well as the IRA RMD. So at 72, you're going to be required to take out a mandatory amount, which is based on your 12/31 balance of the year prior, and it's a percentage which creeps up every year as you age. Now, your Roth provisions of an IRA do not have a required minimum distribution, nor would that even be included in MAGI. But your Roth provision of your deferred comp does have a required minimum distribution. So cautious on that one. But in either case, whether it came from your deferred comp or your IRA, it would not be included in your modified adjusted income. 1031 exchange is currently available. If in doubt, Google it. 1031 exchange, I know we can do it with investment properties. I'm not sure about the residential properties. I'd look that up again real quick. So I'm going to defer that to you guys looking at a tax professional. Maybe I'll have some time to look it up when we get a break or so towards the end. But put that on. I would definitely put a pin in that one. Selling the home is the one that we always see that hurt people in that modified adjusted gross income. That's a total surprise to them that they had no idea was going to hit them. That's the one killer for that 1 year we see happen again and again and again. Back on long-term care, your disability coverage will only cover you when you're working. They cover an employed income, not a retired income. Medicare is very limited, and your health insurance is not going to be paying other than for your hospital stay and the doctor's visits, not for your care. Long-term care insurance, which is that insurance contract I was referencing, can provide benefits for you in a facility, in a nursing home, in an adult daycare, kind of where you dropping your kids off at school and then picking them up at the end of the day. It can, more importantly, be in your home, which is where most people would like it. It could be in assisted living, it could be in hospice, which is the final stages, and it has respite care, which also helps to pay for the caregiver and having a break in caring for you too. It's like a vacation time for them. So long-term care is usually very comprehensive, and no matter what facility you would be in or type of facility, you don't want to be limited. So long-term care insurance will typically cover you in all these types of facilities. So you want to make sure that it's very broad like that. Now, what happens if we don't address this at all? Well, no plan in place. This is what we typically see. Family is going to provide the care. And the care responsibilities are not shared equally. I would definitely be able to chime in on that one. Saw that happen with my own family. Tensions will mount, absolutely, because someone's providing the care, somebody's lifestyle is being pinched, and other siblings are not. Typically, what do we see? The parents come into the home, we care for them, and there may be a few on the line here that they're doing this themselves. And siblings will call every couple of weeks and say, how's mom doing? How's dad doing? And tensions will mount because it interrupts your lifestyle. Your career gets interrupted because you find that you got to take sick days off to take mom here or dad there. You find that that you're going to not spend as much time with the kids because you're taking care of mom, you're taking care of dad, and it starts to tear your family apart. And then retirement savings can be decimated. Things that you wanted to leave to your next generation, they get decimated. And in a market like right now, you're selling when the market is really very rough, so it becomes much more expensive. And then you have that reduction of legacy. So there's many, many things this ties into. And interestingly enough, the faces of informal care look like this. Oops, too fast. The primary caregiver tends to be the female spouse and the oldest daughter. Those are the two that provide the highest level of care to people needing it when there's no plan in place. And it's hard on the caregiver. I just lost my dad on December 25th, Christmas morning at 9 o'clock. He passed away. My mom was his caregiver for 5 years. They had no long-term care in place. It decimated their retirement savings. It changed their lifestyle. My mom didn't have the retirement she was hoping she would have. And in the very end, she went from 145 pounds down to 103 pounds in providing the care. So I can tell you that it works a hardship on that person as hard as the person who needs the care. So if you're considering insurance as an option for that protection, well, how does it work? Well, to qualify to receive benefits, typically you must be unable to perform 2 or more of the activities of daily living. And they're defined as eating, bathing, dressing, toileting, transferring, and continence. Now, cognitive, you notice, is not in there, but cognitive usually leads to 2 or more of those. And so the insurance company, what they're going to say is, well, if you are considering long-term care, number one, you want to make sure it's very broad in the facilities that it would cover. And number two, when does it kick in? Well, it's going to kick in after a deductible period, or they call it an elimination period. 30 days, 60 days, 90 days. How long after these people cannot perform 2 or more of these activities of daily living, when does it kick in? Well, you would determine that ahead of time. So you would purchase that ahead of time. You have to define that, not at the time of claim, but at the time of the purchase of the contract. And the next question would be, well, how much coverage do you want to be protected for? Well, $100 a day, $150 a day. Some companies only quote you monthly, $5,000 a month, $6,000 a month, etc. The question came in too, are monthly payouts from long-term care insurance taxable income? No. There are a lot of ways to receive, depending on how they're purchased and what type of long-term care you purchase, where it will be tax-free. And that goes back to that MAGI. The benefits from that will not be taxable. There are situations where part of that income could be taxable. And that's the difference between what they call reimbursement plans or reimbursement plans or indemnity plans. There's a difference between the two. A reimbursement plan will just reimburse you for the amount that you suffered in terms of expenses up to a maximum. An indemnity plan is going to pay you that monthly benefit whether or not you need it at all or not, up to that maximum. And if you didn't need it, what wasn't needed would be taxable. So there are two different types of plans out there. So you've got when does it kick in? How much a day would it be? And then how long do you want it to last for you? 2 years, 3 years, 5 years, a lifetime? How long would you want that coverage to last? And do you want it to cover both spouses jointly as a pool of money, or could it cover each of you individually? Lifetime will always mean that there's no limit on the pool, and you can have those benefits paid directly to the facility if you'd like, so you don't have to deal with all the bill paying, et cetera. To qualify and to get long-term care insurance, you have to provide evidence of insurability, is what it's called. You've got to fill out an application. You've got to let them know about your health. They're going to underwrite it. They're going to write your doctors and see if the risk of underwriting you and insuring you is acceptable. So you've got to qualify for it. And then another bullet point I have here is you can buy compound inflation. Well, I'm 58 years old and I bought $100 a day in benefit. Well, $100 a day in benefit is not going to be anything when I really need it in my late 70s, which is most likely when I would need it. I need that $100 to go up every day. So I got to qualify for it by filling out an application, and then I have to decide when do I want it to kick in. I need to find out how much a day I want it to provide, and I want to know how long it's going to last, and then I need some kind of compound inflation here. Now, I changed the font just a little bit here because these are questions or things that come up very often. Premiums are usually not guaranteed on these products. So there's a lot of them out there that you can choose from, and typically the premiums are not guaranteed. But they can't raise you individually because you're turning in claims. It's not like your auto insurance where you crash your car and they increase your premiums. They have to increase everybody in the state in the same circumstance, the same way. So your premiums can go up, and they do go up in some of these contracts that are not guaranteed, but they can't single you out. I get the question, what age should I consider it? You should consider it at all ages. Usually when you start seeing and thinking about it, from my experiences, in your mid-50s, people are wondering, should I consider it or not? And by purchasing it when you're younger, the premiums will be lower. You can purchase it through your associations, through some of your ASIPSA connections, and you can also purchase it outside by licensed long-term care insurance people that are specially credentialed in the state of California to be able to present this to you. Let's see, I got another question there too that came up here. Let me answer the questions here. Does paying to Medicare Part B lower your taxable income? It's not a deductible expense, no. Is there an age limit to apply for long-term insurance? There usually is, and there's also a point where it really doesn't become affordable. By the time you really look at it in your mid-70s to late 70s, it becomes much more expensive and maybe easier or more appropriate to self-insure at that point. You have to weigh it out, though, to get the proper pieces to weigh that out, though. Then Stephanie put out Lacer's Medicare informational session is scheduled August 17th, and there's a link to it. So that's going to be a really good piece to help you all understand when to get into Medicare, how it integrates in with your Lacer's plan, et cetera. The monthly premiums for long-term care insurance are pretty high at our higher ages. Are there any alternatives to long-term care insurance that provide similar benefits? I got an answer right here on the screen here, Nancy, that may work. Let's see. Give me 1 second here. And then it says, if we sell our home, thank you, Jay. If we sell our home and buy another home, what amount will be included in the MAGI, the net profit or the total gain? It's going to be, net profit is what would be taxable, not the total gain. And what you're usually able to do is, okay, I bought my house for 100 and I sold it for 400, but you had improvements that you had each year over that period of time. So your accounting professional will help you determine what those improvements will be over time. So you can kind of squeeze that gap between what I paid for it and what it's worth now and close it down. And that'll be your gain at the very end. So Nancy, let's see. How do you self-insure? My father's 87, not feeling well. What can I do to make retirement more stress-free and his life well taken care of? Well, if he's not feeling well and he needs care, it's who's going to provide the care and where is the care going to be provided? Jay, is what we usually see the first few questions being answered. I'm going to cover this slide here first, and I may have an answer on it for you. Because of some of the downfalls of long-term care that you guys have put in the questioning here too, and what I have on the slide, premiums are not guaranteed. That's a big one. As I go through time, what if I never use the long-term care and I just pass away never using it? Do we get anything back? No, you don't. It's done. What happens if I keep paying the premiums and then I can't afford it anymore and I drop it? Do I get anything back? No, you don't. So you have some caution items on those levels of long-term care. The marketplace is evolved as you need and require different items or different levels of coverage. The insurance company involves with you. Your demand helps create the new products. There are other products out there now called asset-based long-term care plans. They're becoming very popular. Yes, they tend to cost a little bit more. But what they do is if you never use the long-term care, it gets paid out to your family in a tax-free benefit. If you use the long-term care, more than likely all the care will be tax-free that you receive. Your premiums are guaranteed, and if you cancel it, it can be created in such a way that you can get a portion of your premiums, if not all of them, back from the insurance company. But they tend to be a little bit more expensive in your consideration. So asset-based long-term care plans are a way to as an alternative to look at to some of the traditional things there. And those two, you need to find a properly licensed person in the state of California to represent those for you. And there's a good 3-4 companies out there that offer that product. This may help you here, Jay. I don't know if your dad is a veteran, but aid and attendance for military, depending on when you served and where they were served, there's people that would qualify for long-term care benefits from the Veterans Administration. It's called aid and attendance. And you have to start spending through your assets. There are requirements in order to qualify for it, but I would tell you to seek out the Veterans Administration, ask them about aid and attendance and how it might work. There's a benefit for the veteran. There's also a benefit for the veteran's spouse. So self-insuring, Jay, just to respond to that, just means that as the care comes through, or as it's provided, you write the check for it from somewhere, whether it's a retirement plan, my savings account, my investment account. You would self-insure and just pay for that yourself. How will I be able to choose a good company for asset-based? At 87 and him not feeling real well, he's got to qualify for it. That's going to be another problem. Asset-based, you do have to qualify for too. So if he's not feeling well, there's highly unlikely that he might be able to qualify for it, and the asset-based may not work for him. So I don't have any real good news for you. The only other thing I can think of that some folks have used is if you can predict what the cost of the care will be, for example, say $5,000 a month, you could take a lump sum of money and give it to an insurance company and trade it for a $5,000 a month income so that you know that every month $5,000 a month is coming in to pay for that care, regardless of how long the person would live. And if you didn't receive all your money back, that if the person were to pass, you would get the residual back. You could set it up that way. That's possible. So insurance company annuities might be a way to create the predictable payment that you may need for the care that you have to pay for individual, but it doesn't give you any real advantage of leverage other than just security of that premium or the amount coming in that you need to pay for the care. See that used occasionally. A lot of good questions here on long-term care. So should you consider as part of your insurance portfolio? How much do you own? Have you ever had, I know there's a few on the line here that you're probably nodding your heads. You have cared for a parent or a relative. Would my children care for me? Would my spouse care for me? If I had a change in health and I had to pay for my care, where would the money come from? How many years of care would that provide me? So whether you're going to have a spouse provide, whether you're going to have children provide, whether you're going to have your assets provide, or whether you're going to have an insurance contract or a combination of the above help provide. In the end, just to give you an example, what we did with my parents, not having any long-term care, was my mom had somebody that would come into the home and help during the day, 5 to 6 hours a day, and then she would provide the care on the other times off. So it was a combination of her providing care plus their retirement assets paying for the 5 to 6 hours a day. Let's see if we have any more questions here. We're winding down to the 11:30 mark. We'll be done right about 11:30. Perfect timing. Estate considerations. This actually goes pretty quick. And I don't want to put you to sleep on this one because I can't tell you how important this part really is. You all have worked a long career and worked hard and you've acquired things. And one day you're not going to be here anymore, and those things are going to go to somebody else. And estate planning is not because you're rich and you need to do special planning. Estate planning is because you want to make sure your things get to the places that you want them to go. So I'm going to give you an example of how important and how overlooked estate planning can be. And this is a real example, and this is an old story, so every time I'm recorded, if you've heard it before, you were on this last year, I'm sorry to repeat the story, but it really tells it well. But the very first person I hired in this business was a guy named Pat in 1990. And Pat helped me build my organization. Pat came straight out of school, out of college. And when Pat was growing up, his grandpa was a master carpenter. His dad did the same kind of work, but his dad was a CHP officer. So he did it in his off time. And Pat learned how to build stuff and still is very, very competent in building stuff. So Pat and his dad and grandpa, because Pat was a young teenager, Pat and his dad, his mom and dad were divorced. Pat was living with his dad. And Pat and dad and grandpa built a home together for Pat and dad. And they moved into it, nice home on the west side of Los Angeles. And eventually Pat's dad remarried when Pat was about 16, brought in a new wife, and she had 2 kids, brought them into the home. Pat didn't like these kids at all. He beat them up on a regular basis. And at age 17, Pat's dad developed cancer. And at age 18, Pat lost his dad. And his mom kicked him out of the house. His stepmom kicked him out of the house. That house is now owned by her. And when she passes away, it's going to go to her kids. Pat's dad didn't mean that to happen, just from lack of planning and understanding that's what ultimately happened. So estate planning is about getting your stuff where you want it to go. So this is the second of life's 2 guarantees. In California, you don't have to use an attorney for estate planning, but I don't care what state you're in, I think it'd be very important to engage proper legal counsel to do your estate planning for your unique situations. Typical documents that your estate planning, and I think they have a piece in the Lacers education on estate planning that I will encourage you to go to and how important it is. Typical documents they use to in the estate planning process is really a function of what stuff do you have and where do you want the stuff to go. They could use very common instruments or things like wills, revocable living trusts, powers of attorney, pour-over wills, healthcare powers of attorney, living will, advanced healthcare directives, very, very common pieces for directing where your wealth will go, but also how your health will be dealt with when you can no longer speak your own wishes. So there's many, many, many more documents, but again, it depends on what your stuff is and where you want it to go. So you say, well, how much does this cost and why would I do it? Well, simplicity versus complexity is really what's going to dictate the cost. Oftentimes it's how you have assets owned and how you want them to be owned going forward. Do I have minor children that need guardianship? Who's going to manage those assets on behalf of those minor children? And I can tell you, being in the financial services business and financial planning business for as long as I've been in, that when somebody passes away, I got to tell you, a lot of people come out of the woodwork looking for money. And if you have things like many have, very common to see folks with special needs children. Special needs children need special planning items to make sure that they can still use the government-funded programs, but still have assets for them for their care when you're no longer here. That can't be touched by anybody and can't be used by and also touched by the state in addition to the state programs. Asset protection from former spouses. That's very important to me. Spent a number of years building a business, and I have retirement accounts, and I have my home, and we have our assets. And if something happens to me, I travel a lot to do these presentations, and something happens to me, my wife is the type of person that she would remarry, and I'm okay with that. That's fine. I'm no longer here. But if she remarries, I don't want to take care of him, and I don't want my things that I did with her and with my kids to go to his kids. So I have certain asset protection things I've put into place for her. And then also my children, as they marry, and if they have troublesome marriages and and things that I've saved that go to them and they handle it improperly, that could end up being property of their spouse that they don't like being married to. So I have protection items put into place for them there too. And you may be dealing with that yourself. You may be anticipating inheritance from your parents. And so you may want to keep those assets separate from your spouse and have asset protection for yourself and your kids around that too. So an estate planning attorney will help you with your unique issues, whether it's asset protection from spouse or kids, or you have a kid that could be dependency, has a dependency problem or a spendthrift problem. There's lots of planning things that can be done. Bing Crosby was an example we use all the time, that he wouldn't let his kids have anything until they turned age 65. That was the change that he put on his estate planning for his kids. So you can have many, many wishes, and they can all be voiced and heard and employed from beyond the grave with proper estate planning. So it is for everybody. So I'm not going to go through this. This is just a kind of a summary of that. I items already. So where do we put it all together today, and also with what we did a week ago? Well, the basics of all financial planning is really the very base of any pyramid for financial planning would be insurance coverages. If you've got your life insurance, you need to visit with your agent or with the product frequently to know if it's ever going to expire, if it's ever going to go up in premium, and that the life insurance is there for the reason you need it there for as long as it needs to be there. For auto and home, what's most important about that is that you have liability limits there, and the liability limits there that will protect you in case something happens, that they don't come after you and take your other items, which would also include the use of an umbrella policy, which would cover you in case of a liability that would occur that you're exposed to. Could be an accident, slip and fall, whatever it may be, but they don't come after your assets, they come after the insurance. Health insurance, there's some uniqueness to your LACERS retiree health plan, that you're very careful with that, and that you consider long-term care protection, whether it be a spouse's help, whether it be your money, or whether it be insurance contracts, or a combination of the three. We talked about some eroding factors throughout the last couple of sessions, whether it be taxation, whether it be how we spend money from our retirement accounts, invest money from our retirement accounts, debt, Social Security planning, MAGI versus understanding how that can increase your Medicare Part B premiums, all property taxes, all these things that we talked about, all these areas where we spend sometimes can seem small, but when you add them up and make them collective, they can be a pretty large amount of cash flow in retirement. Review your retirement paycheck. If you need additional income, where's it going to come from? Would it come from employment? Would it come from spending more from your deferred comp? Would it come from Social Security? We talked about debt already. Minimizing debt is going to be the best thing you can do in servicing it and getting those interest payments and those principal payments back to you into your lifestyle. Have a plan for spending your deferred compensation, which really was the most that we had most questions we had on last week was really about where should I be. And I think we talked briefly about having a more expanded session on that in the future. Very important that you review all the beneficiaries of your assets. Who's the beneficiary of your deferred compensation program? If you have an IRA, who's the beneficiary? If you own life insurance through your association still, or personally that you've purchased, that you check those beneficiaries, because who's ever down there, that's who's going to get the money. And if you don't want those people on that, or they're deceased, it's going to go to their next of kin. So you got to be very careful at who you've named beneficiaries on all these programs. And do not be intimidated by consulting a tax professional. I give a lot of examples of reasons why you may want to do so, like moving out of state, or how it will affect your MAGI for selling the home, an estate planning attorney, and a financial advisor. And then last, of course, we've got all the LACERS education sessions. I'm just one of many, many people that are involved in it, and they've got a great program for you to have a lot of, to gather a lot of information. Stephanie, you had mentioned some of our links that we have. That, again, this will be in the presentation. You got ssa.gov for your Social Security. We've got the taxes by state. We've got the Vanguard, which was the nest egg calculator we had talked about in the previous session, your LACERS YouTube programs, health benefits guide, on down. You've got a lot of videos that they've put together on the LACERS site. all informational, and I think this will be recorded for you too to come back and review. So with that, let me see if there's a couple more questions that came through. Some limited in-home benefits available through the health plan carriers. These will be covered in your open enrollment. Okay, I was unaware of that. Thank you, Stephanie. So yes, so your health insurance might have some provisions to pay for some care. You suggested an insurance annuity so you can have it pay off earlier instead of death. Correct. Yeah, it would pay income for you rather than a death benefit. It provides you a known amount of income for an unknown amount of time, 10 years, 15 years, 20 years. So yeah, Jay, income annuities are primarily for income creation. They can save money in them, but they're originally really just for income creation. And my reference to that was just to help you create a predictable stream of income to come in to help pay for care should your dad need that. In another, if we sell our home and buy another home, what amount would be included in the MAGI? Okay, I addressed that one, I think, already, but just to repeat it in case I missed it. And what amount would be included in the MAGI? Well, it's going to be the gain on your old home. So what will the gain be on that old home? Actually, very important too, is you got to, if you're going to sell your home and buy another one, we've got some great property tax incentives here too. You know, my parents, when they sold the family home, they were only paying $350 a month, I mean a year, in property taxes. It was ridiculous. It was super, super low. But if they sold their home and bought a new one, they would have a new property tax base. And some counties, though, would allow them to keep that property tax base from the home that they sold in Los Angeles. So again, paying more property tax is a hole in your boat. It's an eroding factor. So you want to make sure, again, working with a tax professional, you sell that home and you know where the next one's going to be. What is your property tax base going to be for that next home? Can you maintain and keep the one that you have via treaties that you have between counties or are you going to be paying a higher property tax? So you got to take that into account too. My goal is to have enough money to cover staying in a senior home living facility if necessary, because then I cannot live in my home alone instead of the street. I guess I better invest in an asset-based long-term care. You know, Jay, if you know, find yourself they're out there. Get yourself a good long-term care person that you can talk to. You've got some programs through your associations you can talk to. Those people are pretty knowledgeable. Let them know about your dad's situation and what your concerns are, and they might be a good place to start. You can also, oftentimes how people meet me is by word of mouth that said, hey, you know, this guy I talked to, he seemed to know what he was talking about. And so maybe you can talk to a family member or a friend or a close friend, ask them what they've done, and they might be able to introduce you to somebody that really knows long-term care pretty well. We sell our home and have a profit. Isn't there some sort of program that allows older people to subtract a large amount from the profit before getting taxed? Yes, Nancy, you are correct. There's an exempt amount. You are absolutely right. And again, I'm going to take you back to refer you back, just not knowing your situation, single, married, how much you've made on the property, where you might have some improvements that you could depreciate from that. Get to your tax person and have them help you there. And then where you're going, also double check how those new property taxes will work for you, because you could see yourself in a substantial increase in property taxes. And Stephanie had put, Stephanie, you put in there, R. Lacey, I'm not really sure what that association, Retired Los Angeles City Employee Insurance, is that what that stands for? I think that acronym in there. Oh, that was a good guess, wasn't it? Okay, with that, that's my last slide. Thank you.
Yes, Rob, you did an excellent job as usual. We really appreciate your expertise, and we look forward to having you with Lacers, especially with your expertise in the municipal arena. So we really appreciate that, because you really consider that, and we appreciate it. I did want to share, because I attended a seminar last night with a speaker. He addressed some of the financial issues facing seniors. obviously is inflation, interest rates, and war. And there's some tips that he shared that I wanted to share from notes that I took last night. He said, and these are ways to save during your, retirement. He said, buy gas on Mondays. I guess Mondays are those days that are best to buy gas. I don't know if that has to do with the oil shipments. I really don't know, but he advised buy gas on Mondays. He said pay using a
Cash.
yes, pay using cash and or the savings programs. I think Vons and Ralph's have those.
Reward cards, yes.
Reward cards, correct. Costco, Sam's Club, the gas is cheaper there. And where he was going with this is the money that you're saving from that is money that you can utilize for investments, over time. He also said there's a Gas Buddy app that you could utilize to find the lowest price gas. And something that I didn't know is you can renegotiate your car insurance. He said call a few of the car insurance companies and you can renegotiate your car. I didn't know you could do that. I didn't know about raising your deductible. So he said if your deductible is currently $250, you might want to raise it to $500. That will save you some dollars as well. Of course, a lot of people are going towards the hybrid, the electric vehicle, if they're in for buying a new vehicle at this time. But I know that supply and demand is an issue though too. So that's a good option. He says, and I know I've heard these on TV as well, buy your groceries on sale, buy in season, buy your fruits and vegetables or really your fruits in season, buy the store brands versus the name brand. And then he just said, be creative, instead of going out and buying a pizza, make your pizza at home. So he was just giving some tips that these are some that you may have heard, but a couple of them I hadn't heard about. Hopefully that will help you save some dollars that you can be able to add to your investments. Looks like Jay said buy gas on Monday, Tuesday, or Wednesday because demand is lower before the weekend rush to travel. Thanks for that, Jay. With that, I will leave you for the rest of your day. Stay cool, stay safe, and we look forward to seeing you at the next Lacers Well webinar. So bye, everybody.